Hello, and welcome to Capital Markets Live. I'm Alvin Lam, Managing Director for International Markets at Ginnie Mae. For our first episode, we talk with Jim Palmieri. He's the Managing Director and Head of Structured Credit for State Street Global Advisors. In this conversation, we discuss the performance of Ginnie Mae securities during the coronavirus pandemic and what these developments mean for investors concerned about the performance of their MBS. Jim, welcome to the inaugural edition of Capital Markets Live.
Thank you. It's good to be here.
It has been several months since coronavirus disrupted our lives. We have seen with the rise in unemployment, the U.S. government developed programs that help borrowers make mortgage payments, like supplemental unemployment insurance and the Paycheck Protection Program, or PPP, under the CARES Act. How has COVID-19 affected the current MBS environment?
The current environment reflects the enormous government response to COVID-19. As a result, we've seen a collapse in interest rates and FX hedging costs, a remarkable recovery in risk assets, particularly the stock market and the U.S. corporate credit market, and record low mortgage rates resulting in faster mortgage prepayments. As you mentioned, U.S. policymakers reacted quickly with novel forbearance policies to help build a bridge through the crisis, which to date has supported the housing market and limited involuntary prepayments. Of course, uncertainty remains regarding the path of COVID-19 and the pace of the economic recovery, which of course creates involuntary prepayment uncertainty, in particular for Ginnie MBS. Specifically, bank buyouts have picked up in the past few months, but there is still uncertainty regarding the expected pace and magnitude of non-bank buyouts.
I want to follow up on this. Investors have great concerns about the buyouts. What is your outlook for non-bank buyouts?
Our outlook for non-bank buyouts factor in the capacity constraints that exist within the non-bank servicer system, the flexibility for borrowers to extend forbearance, and our economic recovery outlook. On the margin, the more optimistic one is on the recovery, the less of a problem buyouts will be from non-bank servicers as delinquent mortgage loans will cure, and of course, vice versa.
Thank you for answering that. Do you think all of the bad news has been priced into the Ginnie Mae MBS market?
Well, Ginnie Mae UMBS spread pricing has repriced significantly over the past 3 months in response to this uncertainty. For example, the Ginnie Mae UMBS 2.5 swap has fallen more than 40 ticks in that period, and the spread between the two is now roughly flat. Now, regarding whether all of the bad news has been priced in, I would say that based upon our analysis, a fair amount of bad news has been priced in, and we think that a relative value case can be made in favor of Ginnie Mae MBS. In fact, Street Research is already picking up on the relative value of the Ginnie Mae UMBS 2.5 swap, and they've produced a fundamental and technical analysis for the trade at current market pricing. And finally, given the remarkable recovery observed in corporate credit spreads, we see corporate credit spreads in the context of long-term fair value versus Ginnie Mae MBS. There's a case to be made for the stability and diversification benefits of Ginnie Mae MBS versus corporate credit. Benefits that reveal themselves during the spike in market volatility experienced in March of this year.
Great. Going forward, what variables will you follow to improve the outlook for Ginnie Mae securities?
Well, first, we'll look for continued signs of a slowdown in Ginnie Mae prepayment speeds. The August and September prepayment reports were favorable, as with some clarity on the topic of non-bank buyout activity. Also, continued improvement in the U.S. economy's recovery would lower the unemployment rate and, as a result, reduce uncertainty regarding involuntary prepayments or buyout risk. And of course, a COVID-19 vaccine would be a game changer.
Indeed. More broadly speaking, what is your overall outlook for the U.S.?
Of course, the path of COVID-19 will continue to play a central role in determining the speed and length of the recovery. As a firm, we see the recovery linked to 4 legs of a stool, with COVID-19, monetary policy, fiscal policy, and the price of oil representing the 4 legs. Now, we've seen improvements in COVID-19 versus the peak. We continue to see substantial and persistent monetary policy support. Substantial fiscal policy stimulus remains in place, and we've seen a recovery of oil prices back to 40. Importantly, we've observed a significant pickup in economic activity, not only in the US, but across the globe, and we continue to expect improvements in economic activity in the near term. A continued improvement in economic activity could result in a moderate increase in long-term US interest rates, which of course would serve to dampen voluntary prepayment speeds for Ginnie MBS as well.
Well, thank you so much, Jim, for your time and insights.
Thank you.
That was Jim Palmieri, Managing Director and Head of Structured Credit at State Street Global Advisors. If you like our podcast, be sure to subscribe to future episodes of Capital Markets Live on YouTube. Have comments or questions about today's episode or other topics? Send us an email at ocmglobalinvestorinquiry@gov or message us on Twitter @GinnieMaeGov. Until then, stay healthy and prosper.